The next offer we're going to discuss is listing your home traditionally with a realtor. I work with a number of different realtors, and we can certainly find a realtor to help list your home. And when you list a home, here's what you can expect. And again, we'll go through this for our generic house. The offer that you would expect to see would be basically the fair market value. Minus any repairs that are needed. So this house that we're talking about, its fair market value is $150,000. It needs $5,000 in repairs. So you would expect to see an offer for $145,000. Now, obviously, the market's a little tough out there, and you may not get a full fair market value. But if you do wait long enough, you would expect to get the fair market value. After all, the definition of the fair market value is what will you actually get in terms of an offer. So on this house, we'd get a fair market value of $145,000. If you sell a home traditionally, it does not impact your credit. Kind of the downside of selling traditionally is it tends to take a long time. Right now, across North America, there's more than 6 months of inventory for most homes. So that means that on average, it takes more than 6 months to sell a house. Now, there's a little bit of a luck element involved, so, your mileage may vary. It may be a little faster, maybe a little slower. Certainly, if you drop the price more, tends to sell faster. If you want full fair market value, tends to sell slower. And in this scenario, with a $150,000 home, what the seller is going to have to do is they're basically going to have to take a minor, that $5,000 concession in order to cover the repairs. That's reflected in the value. And then, of course, the seller has to pay all of the normal selling costs, which are about 10% of the offer, which would be about $14,500. So $14,500 plus the $5,000 repairs. The seller would probably bring about $24,500 to the table. So the listing option in this generic house example takes 6 months plus or minus and requires about $24,500. However, it does not impact your credit. Our next option for selling the home is using a strategy called a short sale. And I do a lot of short sales. My company's actually done over 1,000 short sales, and we can certainly help facilitate a short sale for you if this is the best option for your situation. Let's go through kind of what a short sale would look like for our generic home example. Typically, when somebody buys a short sale, it's a little bit more, tricky than buying a regular house. So typically a short sale would sell for about 90% of the fair market value minus the cost of the repairs. So in our example here, you'd sell a house with a short sale, you would expect to see an offer of around $130,000. Again, could be higher, could be lower, but that's pretty typical. Now the downside about a short sale is it does have an impact on your credit. Whether it works or not, you're going to get a big credit hit. And unfortunately, about 50% of short sales are denied or never actually sell or ultimately result in foreclosure. So you got about a 50-50 chance of a foreclosure, but it will hurt your credit pretty badly either way. How long does a short sale take? Short sales take a long time, typically 6 to 9 months, could be longer. We actually just finished one that took 17 months. It can be a little faster too. There's an element of variability and luck involved. And the good news, though, is that a short sale actually the seller doesn't have to bring any money to the table. Now, there are a few caveats to that. When you do a short sale, you can get a deficiency judgment. In other words, the lender could actually sue you for the loss. They're going to take a loss, a pretty significant loss, because of mathematical things, beyond the scope of this discussion here. They could actually sue you for up to the full value of the loan. You can also get 1099 statements from the lenders This could mean you have additional tax liability, and there's a number of other credit and monetary considerations as well. But in general, this is what a short sale looks like. 6 to 9 months, 130,000, and the downside is it hurts your credit, and there may be other financial concerns as well. Our next option is a foreclosure, and there's a couple of variations about this. You could also do something called a deed in lieu, where you just deed the property back to the lender. From a credit and functional perspective, there's really no difference between that. Generally, a lender won't even approve a deed in lieu until you've already tried a short sale and the short sale has failed. So most people, or some people, when they're in a difficult situation, they need to sell a home quickly because maybe they can't afford it any longer, consider foreclosure as one of their options. So let's go through the foreclosure. What's the offer? Well, there is no offer and there's no formula. The biggest, of course, problem or downside with a foreclosure is the atomic bomb of credit scars. It is the big one that cuts your score the deepest, and it lasts the longest. And I know that some sellers think, oh, I'm just so tired of this house. I just want to walk away. I don't want it anymore. I don't want to deal with this. And they think that a foreclosure is kind of the end of the problem. But the truth is that a foreclosure is really the beginning of a 10-year nightmare that starts with, having your home foreclosed on the courthouse steps. If you're still in the home, you get evicted. The sheriff would even drag you and your family out onto the curb with all your stuff. Most people move out before that. But then you have a decade of creditors calling, dealing with deficiency judgments, tax implications, not being able to get a credit card or buy a car, and some jobs will even be affected by your credit standing. In other words, some people even have trouble getting employment after foreclosure. So I guess the bottom line is I would really strongly recommend that a foreclosure is not a very good option, but it is one of the considerations that some people have. Not most, but some people have, depending on their individual circumstance when they're selling a home. The good news about a foreclosure is, right, it doesn't cost you anything, but like a short sale, there can be deficiency judgments, 1099s, and a variety of other financial and credit implications. Our last option is an option called a mortgage assignment. And a mortgage assignment is basically where the seller assigns their mortgage payments to a buyer in exchange for transfer of ownership. In other words, the buyer is going to make the payment on the seller's loan going forward. Now, I do want to explain this is not a loan assumption. A loan assumption is when the lender transfers the loan from the seller to the buyer. And virtually no loans are assumable, and lenders generally don't approve loan assumptions. They would have to requalify the buyer. However, an assignment is a little bit different. An assignment is only approved by the seller, and the seller gets into a contractual agreement with the buyer where the buyer is now responsible for making the payment on the existing loan in exchange for ownership. When you sell a home with a mortgage assignment, just like any type of an owner financing situation, because lending is difficult now because loans are at a premium, when a home comes with a loan, generally that home will sell for a premium. It will sell faster and it will sell for more money. So the fair market value of a home that comes with financing is basically the loan balance. So in this example with our generic house, you would expect to get an offer for $155,000. Is this impact your credit? No. How long does it take? Typically 2 to 6 weeks. Mortgage assignments or selling homes with financing in this way goes down pretty quickly. In fact, we have hundreds and hundreds of buyers, in fact, nationally, thousands of buyers that already are wanting to buy houses this way. So we can basically match these buyers up with these homes in a very, very quick fashion. And of course, the good news with a mortgage assignment is you don't have to bring any money to the table. In other words, it's actually the buyer that's paying all of the closing costs in these transactions. So those are the 5 different options that you have when you're selling a home. We'd be happy to kind of explain your particular situation and see which option might be the best fit for you.